Every generation swears their bubble is different, but the AI gold rush of 2025 is repeating a dark script. From tulip bulbs worth more than homes, to dot-coms doubling overnight, to $16 trillion lost in a single housing collapse. History shows these manias always end the same way, with ordinary people left shattered. The terrifying AI bubble is about to crash, but why is almost nobody listening? The answer begins with the blueprints of every crash in history. In the winter of 1637, the Dutch Republic found itself gripped by a fever that began with a flower. Tulip bulbs, once a rare curiosity, had become the hottest commodity in Europe. At the height of the mania, a single prized bulb could fetch more than a canal house in Amsterdam, 10 times the annual wage of a skilled worker. Shopkeepers, artisans, even servants abandoned trades to gamble on bulbs, convinced that prices could only rise. Taverns turned into makeshift exchanges. Neighbors boasted of overnight fortunes. The entire social order seemed to tilt toward speculation. Then, in February, the market froze. Bids vanished. Within weeks, tulip prices collapsed by 99%. Years of savings evaporated. Merchants went bankrupt. The Dutch economy, once the envy of Europe, shuddered to a halt. The lesson is clear. When prices are driven by euphoria, not by value, collapse is never far behind. Nearly 3 centuries later, a different kind of mania swept through America. The 1920s roared with jazz, new machines, and a stock market that seemed to defy gravity. The Dow Jones soared 5-fold in just 8 years. Margin lending, borrowing money to buy more stocks, turned ordinary workers into overnight speculators. Everyone had a tip, from Wall Street bankers to shoeshine boys on the corner. Headlines promised endless prosperity. But on October 29, 1929, the illusion shattered. Black Tuesday sent the Dow into freefall, wiping out nearly 90% of its value in the years that followed. $30 billion, $500 billion in today's money, vanished almost overnight. Banks failed, factories closed, breadlines stretched for blocks. The crash didn't just punish the reckless, it dragged down families who had trusted the system. From tulip bulbs to stocks, the pattern is unmistakable. Crowds chase riches, prices soar far beyond reason, and then, suddenly, everything unravels. Whether fueled by flowers or financial instruments, the psychology of the bubble remains the same. The only thing that changes is the asset at the center of the storm. By the late 1990s, a new gold rush had gripped America, this time powered by the promise of the internet. Startups with nothing but a website and a catchy name saw their valuations soar overnight. Pets.com became a household name not for profits, but for its sock puppet mascot and million-dollar Super Bowl ads. Webvan spent hundreds of millions building warehouses for online groceries, burning through cash at a rate that stunned even the most seasoned investors. It didn't matter that these companies had no clear path to profit. If it ended in .com, the stock price doubled. By March 2000, the Nasdaq had climbed to dizzying heights. Then, almost without warning, the bottom fell out. Over the next 2 years, the Nasdaq lost 78% of its value. $5 trillion in wealth simply vanished. Offices emptied overnight, and workers who once dreamed of stock option fortunes filed for unemployment instead. The cycle repeated itself just a few years later, this time with real estate. In the mid-2000s, banks handed out mortgages with barely a question. Home prices soared as everyone from first-time buyers to corporate flippers scrambled to get in on the action. Television promised that anyone could get rich flipping houses. Seminars filled hotel ballrooms with eager would-be investors. Behind the scenes, Wall Street bundled risky subprime loans into complex securities and sold them around the world. For a while, it seemed unstoppable. Then, in 2008, the illusion shattered. Lehman Brothers collapsed. Home values plunged. $16 trillion in household wealth evaporated, leaving behind empty homes, shuttered banks, and shattered retirement dreams. In both eras, the warning signs were there. Companies with no revenue going public, families borrowing beyond their means, a tidal wave of easy money and marketing hype drowning out caution. Ordinary people, swept up in the mania, paid the highest price. The lesson is clear. When hope and hype replace fundamentals, collapse is never far behind. Tech stocks now make up more than 40% of the S&P 500, a level of concentration that quietly ties the fate of millions of retirement accounts to just a handful of companies. In the first half of 2025 alone, over $100 billion poured into AI startups, more than every other venture category combined. These companies, from household names to stealthy newcomers, are burning through cash at a historic pace, funding sprawling data centers and hiring armies of engineers. Yet an MIT study found that 95% of businesses adopting generative AI have seen no measurable return on investment, even as their valuations skyrocket. The pattern extends beyond Silicon Valley. Small-cap firms add AI to their names and watch their stock prices double or triple overnight, a trick lifted straight from the dot-com playbook. ETF inflows into AI-themed funds are setting new records, with retail investors piling in at all-time highs. Behind the scenes, insiders are quietly cashing out. Form 4 filings reveal executives at leading AI firms selling tens of millions in shares as the hype peaks. Institutional risk is mounting too. Major pension funds, including CalPERS and the Texas Teachers Retirement System, have approved multi-billion-dollar allocations to AI-focused vehicles, sometimes overruling their own risk managers. As capital expenditures on AI infrastructure reach into the hundreds of billions, the gap between spending and real-world payoff grows wider by the month. The warning signs are everywhere, a checklist of red flags that mirrors every bubble before it. The lesson is clear. When speculation outpaces substance, the script never changes. Every bubble follows the same script. The AI boom of 2025 fits it line by line. First, a new technology appears. Generative AI, large language models, autonomous systems. Early adopters and insiders make fortunes almost overnight. NVIDIA's market cap rockets past $4 trillion. Startups raise billions before showing a single dollar in profit. Then the media steps in. Headlines promise a future remade by artificial intelligence. News anchors, tech blogs, and social feeds churn out endless hype. The story spreads. Missing out is not an option. Next, ordinary people rush in. ETF flows into AI funds break records. Retail investors pile into stocks with AI in the name, hoping to catch the next rocket. Prices soar far beyond any connection to real earnings. Companies trading at 50 times revenue become the new normal. Meanwhile, insiders start selling. SEC filings reveal executives at top AI firms, quietly cashing out tens of millions in stock. Hedge funds and early venture backers shift money elsewhere, leaving latecomers exposed. Then comes the snap. A disappointing earnings report, a failed product launch, or a sudden shift in sentiment triggers panic. Stock prices tumble in hours. The crash wipes out years of paper gains. Ordinary investors, pension funds, and retirement accounts take the brunt of the losses. The lesson is clear. This time is not different. The pattern repeats. Emergence, early fortunes, media hype, retail FOMO, prices detached from reality, insider selling, sudden crash, and mass losses. The crash is coming. The only question is when. In February 1637, Dutch tulip prices collapsed by 99% in weeks, a fact matched by the 78% NASDAQ drop in 2000 and the $16 trillion destroyed in the 2008 housing bust. Each era followed the same steps: rising euphoria, record valuations, and sudden collapse. Today, AI companies make up over 40% of the S&P 500's value, with $100 billion in recent venture funding and 95% of projects lacking clear returns, as confirmed by MIT studies and SEC filings. Yet, the exact point of the next crash remains unknown. No public document reveals when the bubble will burst or how deep the fallout will run. What is clear? History shows every speculative surge ends in crisis, and the AI boom of 2025 fits every warning sign documented before. The evidence leaves no doubt. The pattern repeats. The lesson is clear. This time is not different.